When you look at a legacy tech stock, you generally expect one of two stories.
Right, yeah.
It's either a slow, methodical compounder just grinding out those single-digit returns, or it's a dinosaur that's just trapped in this slow, painful decline.
Exactly.
But looking at Intel today, I mean, the price action completely defies both of those archetypes. We are looking at a legacy name sitting at $66.26, and it is up a staggering 79.5% year to date.
It's a chart that looks less like a mature semiconductor company and honestly more like an early-stage biotech firm that just got FDA approval or something.
Yeah, it's wild.
The velocity of this move is it's forcing the entire market to reconsider what this company actually is right now.
And that is exactly the core tension we need to resolve today in this deep dive. Because depending on which institutional desk or, retail forum you monitor, Intel is either the most misunderstood generational AI infrastructure play of the decade.
Or a massive trap.
Right. Or it is a terrifyingly overvalued value trap just waiting to spring.
Yeah.
So we are pulling apart the financials, the order flow data, and the intrinsic valuations to find out if this is a strong buy or if we're just staring at a violent falling trend waiting to happen.
And the timing here is the whole game. I mean, we are doing this analysis today, April 22nd, 2026, because the ultimate catalyst drops tomorrow.
Oh, yeah.
April 23rd is Q1 2026 earnings day for Intel. The entire semiconductor sector is basically holding its breath for tomorrow's guidance.
For sure. And before we tear into that balance sheet to see what tomorrow might look like, do us a quick favor, hit the like button, subscribe to our YouTube channel, and you must leave a comment with your feedback below.
Yes, definitely.
Are you holding, buying, or shorting going into tomorrow? We really want your read on this. And as always, a quick reminder for everyone listening, we are here to decode the market mechanics and synthesize the research for you.
Right. This is an analysis of data and market sentiment, not financial advice.
Exactly. So let's get straight into the actual ledger. Because to understand how a stock jumps nearly 80% in a few months, you have to look under the hood.
You really do. You have to see if the engine can actually support the chassis, right? And the balance sheet presents this fascinating duality right now.
How so?
Well, on one hand, you have this staggering scale. Total assets are sitting at $211.43 billion against total liabilities of $85.07 billion.
Okay, wow. So from a pure solvency standpoint, they have the mass. I mean, they are a fortress.
They are.
But having assets on paper and having liquid cash flow are two very different things.
Oh, absolutely.
Because when I look at the cash flow statement, the narrative gets incredibly complicated. Like, operating cash flow actually improved last year. They pulled in $9.7 billion from their core business.
Right, so the sales are happening.
Yeah, the sales are happening. But their free cash flow is deeply negative. It's sitting at a deficit of $4.5 billion.
And that deficit is really the defining characteristic of Intel's current corporate strategy.
Right.
Because free cash flow, that's the cash left over after a company pays for its operating expenses and its capital expenditures.
Right, the real money in the bank.
Exactly. And that $4.5 billion negative figure isn't an accident. It is the direct result of their pivot toward the foundry model. I mean, they are pouring billions of dollars into concrete, steel, and these ASML lithography machines to build out fabs globally.
Which brings up the crucial question of sustainability, honestly. It's kind of like a homeowner with a great salary. Right?
Okay. Yeah.
They're bringing in cash, but they are taking on massive debt for a total home renovation. So they're bleeding it out even faster on these heavy foundry investments.
That's a great analogy.
And looking at their income statement, they are suffering from negative net margins. I mean, is this level of spending even sustainable? Building a sovereign semiconductor supply chain is not cheap.
No, it is incredibly capital intensive. They aren't just designing chips anymore. They are trying to physically manufacture them for other companies.
Right.
The capital intensity of building these sub-2 nanometer fabs is almost incomprehensible. We are talking about facilities that cost upwards of $20 billion a piece.
Wow.
And it takes years before a single wafer yields any revenue. But the market is looking at this cash burn and, at least so far this year, deciding to aggressively fund the ambition rather than punish the expense.
Yeah, let's talk about how aggressive that funding has been. Because the 52-week range paints a picture of absolute schizophrenia in the market's assessment.
It really does.
We are talking about a stock that was basically left for dead at a low of $18.25.
Right.
And then it surged to a high of $70.33. And we are currently hovering right near that peak at $66.26.
Which is an incredible swing.
It is. The shift in sentiment from $18 to $70 without a corresponding explosion in current free cash flow, I mean, that implies the market is pricing in a flawless future execution.
It implies that investors believe the bottom is definitively in, and that these investments dragging down current margins will exponentially pay off in 2027 and beyond.
But when fundamental reality like negative free cash flow detaches from stock performance like this, you really have to look at the technical architecture of the trade.
You have to see who is actually driving the price action.
Exactly. And I'm looking at the moving averages right now, and the detachment is just stark. The 50-day moving average is sitting down at $39.34.
Right.
And the 200-day moving average is all the way back at $37.50. So when a stock is trading at 66 cents, it has completely left the gravitational pull of its historical volume profile.
It isn't just trending, it's stretching the rubber band to its absolute limit.
Yeah.
The technicals are heavily skewed bullish, but they are precarious. Like, immediate key support has formed at $65.70.
Okay.
If the stock breaks below that, the algorithm-driven momentum could reverse sharply.
That's a real short-term weakness risk.
It is, and conversely, the resistance is sitting right at that 52-week high of $70.33. So it is squeezed in a very tight channel right near the top of a historic run.
What fascinates me here is the tension in the momentum indicators. I mean, they are practically fighting each other.
Yeah. Oh, totally.
The MBT is sitting at 0.14, which traditionally flags a sustained upward buy signal.
Right. The trend is technically still your friend there.
Right. But then you look at the RSI, the Relative Strength Index, and depending on the time frame you isolate, it ranges from a neutral 50.18 all the way up to 78.20.
And an RSI approaching 80 is screaming that the stock is technically overbought.
Wow, okay.
Yeah, it means the buying pressure has been so relentless that a pullback or consolidation is structurally overdue. When you combine a bullish AMPD with an overbought RSI, it usually signals a stock running on fumes.
So it's moving up, but the underlying buying power is exhausting itself.
Exactly.
Which naturally leads to the most revealing piece of data we pulled for this deep dive. Because if the stock is running on fumes at these levels, we need to know who is pressing the buy button and who is quietly heading for the exits.
Right, who's actually holding the bag.
Exactly. And the order flow data shows a glaring divergence between everyday retail participants and the actual executives inside the building.
The divergence is a textbook psychological study. I mean, on the retail side, sentiment is ferociously bullish.
Oh, yeah.
The data shows 83.2% of retail flow acting as buyers on certain platforms, and that's often characterized by these midday volume spikes.
Yeah, retail traders are reading the AI infrastructure headlines, they're seeing the momentum, and they're just piling in to avoid missing out on the next leg up.
But the insiders, the people with granular visibility into tomorrow's earnings report and the actual progress of these multi-billion-dollar fab builds, they are doing the exact opposite.
Wait, really?
Yeah. Over the last 3 months, company insiders have logged net selling of between $0.73 million and $1.0 million.
Okay, but I mean, you always have to contextualize insider selling, right?
Right.
Executives sell shares to pay taxes or diversify portfolios or buy houses. It isn't always a glaring red flag.
That's true. However, when you see a consistent pattern of net selling specifically clustered near a 52-week high, while retail is aggressively buying,
Wow.
it suggests the smart money inside the firm believes the current valuation is at least fairly priced, if not rich. They are taking chips off the table.
So I'll pose this to you listening right now. If the architects of the turnaround are quietly cashing out and locking in profits near the $66 to $70 highs, are everyday retail traders buying the top and walking blindly into a liquidity trap?
It's a very real danger.
Because this disconnect between retail enthusiasm and insider caution is perfectly mirrored by the absolute fracture taking place among Wall Street analysts regarding Intel's true value.
The institutional consensus is essentially paralyzed right now. We are looking at a pool of 39 analyst ratings, and the overwhelming majority, 27 of them, have stamped a hold rating on the stock.
Just a hold.
Yeah. And then there are 6 sell ratings and only 6 buy ratings.
I mean, stop and think about the math on that. You have a stock that has rallied nearly 80% this year. It is one of the most visible tech names on the entire market.
Right.
Yet out of 39 professional analysts covering the firm, only 6 are willing to tell their clients to actively buy it at this level. The reluctance is deafening.
It is, but the extremes on either side of those holds are what make this stock a true battleground.
Tell me about it.
Well, on the hyper-bullish side, HSBC has set a street high price target of $95.
95. Wow.
Yeah, that target implies they believe the momentum is fully justified and that Intel's fundamental turnaround is going to accelerate way faster than the broader market anticipates.
But on the other side of that $95 target is the intrinsic valuation model. And this is where the value trap argument really gets its teeth.
Oh, absolutely.
Because the G of value, which strips away all the market hype and sentiment and looks purely at historical multiples, past financial performance, and discounted future cash flows, it pegs Intel's true intrinsic worth at just $26.96.
That is a staggering gap. I mean, if the intrinsic value is $26.96 and the stock is trading at $66.26, the GF value model suggests the stock is heavily overvalued by roughly 145.8%.
Over 145% overvalued. That's insane. And the discrepancy really comes down to how you weigh the future versus the past, doesn't it?
Completely. A discounted cash flow model heavily penalizes a company burning $4.5 billion in free cash flow today. It demands proof of future yield.
Right. But the market isn't treating Intel based on what it did last year. It is trading Intel based on a deeply held belief about the macro environment.
Yes.
So to really parse whether $95 or $26 is the correct destination, we have to debate this and stress test the ultimate bull case against the bear case.
Okay, let's do it. The bull case, the best case recovery scenario, hinges on a macro reality that is basically undeniable right now. The world is facing a severe server CPU and AI accelerator shortage.
Yes, demand for compute power is just completely outstripping global manufacturing supply. The total addressable market is expanding at a historic rate.
And Intel is one of the very few entities on the planet with the foundational architecture to actually capture that demand.
And the specific catalyst unlocking that demand for Intel is their 18A node readiness. This isn't just an iterative update either. This is their attempt to leapfrog the competition in semiconductor physics. We are talking about sub-2 nanometer architecture and backside power delivery.
It's massive.
If they execute 18A on time, they suddenly offer a product that competes directly at the bleeding edge, changing the entire narrative of them being this legacy laggard.
The 18A node is the linchpin of their entire foundry strategy. And the bullish analysts are pointing to the blockbuster partnerships brewing around this technology as validation.
Right. The sources highlight data showing ties with Google and Elon Musk's Terafab.
Yeah, and when entities of that scale, who are aggressively trying to secure supply chains outside of Taiwan, attach themselves to your infrastructure, the market prices in a premium.
It's a massive vote of confidence.
Yeah.
I mean, if Google and Musk believe your foundry can deliver, retail investors are going to buy the stock.
Sure.
But there's a dark side to this ambition, and the Gen case is built on the incredibly unforgiving nature of the broader semiconductor war.
Right, because the bear case doesn't debate the size of the total addressable market. It questions Intel's capacity to profitably capture it while fighting a two-front war.
The two-front war.
Yeah, they are trying to compete with TSMC in the foundry space, physically manufacturing chips for third parties. But at the exact same time, they are trying to compete with Nvidia and AMD in the design space.
Let me try to visualize this. It's like a company trying to run a 3 Michelin star restaurant where they design the world's best, most complex menu.
Okay.
That's the design side competing with Nvidia. But simultaneously, they're trying to run a 10,000-acre commercial farm to mass-produce ingredients for their biggest rivals across the street. And that's the foundry side, competing with TSMC.
That is a highly accurate way to frame the structural risk, because TSMC only farms. Nvidia only cooks. Intel is trying to do both, and the capital required to do both is crushing their net margins.
And TSMC already possesses dominant entrenched scale in the foundry market. And Nvidia has absolute design dominance in AI chips. Intel is funding this two-front war with a balance sheet showing negative free cash flow.
Which is terrifying. If the 18A node suffers delays, which, by the way, is notoriously common in advanced semiconductor manufacturing, or if the yields aren't perfectly optimized, the downside risk is incredibly violent.
Because if the 18A node stumbles, the future growth premium just evaporates.
Gone.
And if that premium evaporates, the stock falls back toward that $26.96 intrinsic valuation we talked about.
Yeah.
There is no fundamental floor supporting $66 if the foundry dream fails to execute.
And that margin concern is exactly why 27 institutional analysts are just sitting on their hands with hold ratings.
They are waiting for proof of execution.
Right. The narrative is priced for perfection, but the ledger still shows a company undergoing a highly risky, capital-intensive transition.
So, bringing this all together for you listening, as you watch this stock head into tomorrow's print, we have two completely different timelines operating simultaneously here.
Yeah, we do.
Long-term, Intel's survival and growth hinge entirely on the physics and economics of that 18A node. Can they successfully build the fabs, secure the third-party clients like Google and Terafab, and steal market share back from TSMC without bankrupting their free cash flow in the process?
And that long-term timeline will take years to fully validate. But the short-term outlook is binary, and it resolves tomorrow, April 23rd, 2026.
The moment of truth.
Exactly. The Q1 earnings guidance will force the market to reconcile the 80% year-to-date technical momentum with the actual current financial reality.
The setup is incredibly fragile. You have retail investors heavily long buying into the AI infrastructure narrative. You have technical momentum pushing into overbought territory right at a major resistance ceiling of $70. And you have corporate insiders quietly selling off shares.
It's a powder keg. If the earnings guidance confirms the bull thesis, like if we see concrete progress on 18A yields and improved forward margins, the stock could easily punch through that $70 resistance and chase that $95 HSBC target.
The shorts would be forced to cover, adding fuel to the fire.
Oh, a massive short squeeze.
But consider the alternative, and this is the thought we want to leave you with today. With an RSI flashing overbought and intrinsic models screaming 145% overvaluation, the margin for error is zero.
Zero.
If tomorrow's earnings call reveals even a hint of weakness, a delay in fab construction, a snag in the 18A timeline, or margins compressing further under the weight of this two-front war, will this 80% rally instantly evaporate?
It very well could.
Will we see a scenario where the retail investors who bought the hype at $66 are left holding the bag, while the insiders who quietly exited at the top watch the mean reversion from sidelines?
The market is a mechanism for transferring wealth, and earnings events like tomorrow are usually the catalyst for that transfer.
Tomorrow, the narrative meets the math. We want to know where you stand before the numbers hit the tape, so drop down into the YouTube comments right now. Are you riding the Intel bull wave, trusting the 18A node to deliver? Or are you sitting safely on the sidelines, viewing this as a textbook value trap? Lay out your case. Keep questioning the fundamentals, ignore the noise, and we will catch you on the next deep dive.